Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. I'm really excited to share this video with you guys because what I've just done is some sort of a not rebalancing the portfolio, but I've managed to sell a stock and bought two other stocks. So I'm going to share with you guys what I've sold, the reason why I've done it, and I'm going to tell you exactly what I bought and why I bought these companies. Now, one of the things that I want to say this outright is I've started this whole YouTube channel to kind of share my journey with you guys. So what am I buying? What am I selling? Why am I buying these things? So other people out there just like you can learn from this and see exactly what is possible, because sometimes there's a lot of information out there. There's a lot of people out there who will tell you, I'm buying this, I'm selling this, but you will never ever see their portfolios. They might share their journey with you guys here and there, but they will never ever tell you exactly, you'll never see their portfolios. They'll just tell you exactly, I bought this is how much I own, and so on. I do the opposite. I share everything with you guys, including the family portfolio, which you can get access to if you join us on the Patreon account. You also get access to the subscribe portfolio reviews, which is basically a way to communicate with me and tell me exactly what you own, and I'll give you some sort of a feedback. Now, I'm going to explain the company I sold first and the reason why I sold. Then I'm going to tell you exactly the two other companies, three in fact, that I've actually added to. One is very small. The other two is quite big change. Okay, now let's get started. And the company that I sold is CubeSmart is basically one of the retail company, not retail, REITs, real estate investment trust that I've had in the portfolio for a few years. I think it's been about a year, if I'm not mistaken. And the reason I sold is I just broke even, but the reason I sold it was because it became non-Sharia compliant, and the reason was because it has gone up. Basically the stock went down quite a bit and the debt levels have increased, which means basically the interest bearing debt is now slightly higher. Now there are a few ways of looking at this. Okay, so some people will use the 24 months, some people like the average out the market cap when it comes to the market cap. If you don't know what I'm talking about, if you go to Zoe, it will explain basically 24, 36, whatever. So basically you can still use that. So I kept it because I wanted to make sure that I break even at least by the time I sell it, and basically collected some of the dividends that were on the way. And then what I normally tend to do is I pay some of that money as basically give it to charity. So 5% of the money that I received from them will go to charity, and then I've from the dividend side of things and from the sale I've basically broke even. So I think I've just lost a little bit. It wasn't even breaking even, so it was just lost a little bit, but I think it was my thing was about $42 per share or whatever it was, and I think it was basically I've sold it a couple of days ago. So I'm going to show you now, in fact, just to be honest and transparent. As you can see here, there was a 93 shares that I've had, so I've sold it on the 22nd of July, and these are the two sales basically that I made. Just before that, on the 15th of July, they paid me $30 so £30 in dividends, so that's what I was collecting. So yeah, that's the company that I sold. That's the reason why I sold, and I have used that money to buy other companies. Okay, and I'm going to show you the first one, and that is MSCI. Now I've went from a high yield company, so basically that was like 5% or whatever it was, to a dividend growth company that's right now has a yield of 1.3. For me, it wasn't about this. It was the fact that after the earnings, the company went down a lot. So year to date is actually down 10%, and if you check the S&P 500, we are up quite a lot. Okay, so if you look at the last 5 days, it's down about 6%. It gained back 2 and something percent. So on the day, I think it was down about 8%. And the reason I bought this company is because of the growth side of it. Okay, I genuinely believe this company is going to be in a very good position. The fact that it was down quite a lot, it was nothing to do with the fact that basically they beat both. And I'll show you. In fact, let's go back here. Okay, the top line and bottom line, they beat both of them. Okay, so for the reason it was down, it was nothing to do with that. And it was more to do with something that the CEO said, that basically because of the uncertainty in the market, generally where we are right now with tariffs and everything else, that can impact them in the business in the long run. But everything else was fine. So the top line, bottom line, and reaffirms basically the fiscal year 2025 outlook, which was basically what they said. So yeah, it was just the comment that the CEO made. That's the reason why it went down 10%. I took advantage of that, and I'm going to show you one of the reasons why I actually really like the company. Okay, so if you look at the earnings side of things, if you look at the estimates moving forward, you can see double digits every single year in terms of revenue side and EPS side of things, and in terms of revenue, you almost did double digits there. Now this is a very high quality business in my opinion. As you can see, that dividend, small dividend yield, very safe, 41 billion market cap, and as you can see, the payout ratio very low. The 5-year growth rate is absolutely amazing. The latest increase was really good. 10 years of increasing that dividend. This is what you get for every share of this company that you own. And then right now, as you can see here, this line, basically that dotted line there, is below the that blue line, which means basically it's undervalued. Even if you use the 5 years, you can see that clearly it's been undervalued based on the dividend theory method, right? And if we look at the earnings, basically earnings payout ratio, as you can see, is below that 60%. So that right now basically we're at that 20, we weren't in 20%, but it's slightly going up next year 40%, which is fine. It's not that bad. And look at the growth when it comes to the EPS side of things, from $2.32 to right now 18 and 18.1, which is absolutely amazing. Free cash flow per share is heading in the right direction, and shares outstanding is declining. So that means every share of this company that you own is now basically worth more. Total sales is heading in the right direction. Return on equity, because they do have a higher and I'll show you, in fact, let's just to be honest with you guys, I'm going to show you what the reason why we have a negative return on equity here. And that's if you go to the financials balance sheet, and if you go to the total current assets, which is 1.2, so don't forget that 1.2, against this one here, total current liabilities 1.4, and for that reason we have this situation here. So it's not that big deal, to be honest. That can easily change. Return on invested capital 33%, operating margins of 54%, and free cash flow margin of 46%, and debt levels is quite low as well, which is very nice to see. Now if you look at the fast graph, for example, this company has been trading nicely over in 2014, 2015. It started moving away from that orange line, which is basically based on the earnings side of things. Remember, the price should follow the earnings of the company. Okay, these two should be, this line should be under, which for us to buy it, because that means the company is undervalued at this point in time, even though is higher than the normal PE, and it's been like that for quite some time. Even if we reduce the 10 years, even if we reduce it to 5 years or 6 years. But what I'm really interested is the two things: performance of the stock over the last 10 years, okay, against the S&P 500. And if we bought this company for 10 years ago, and we look at, so 10,000 invested, okay, 10 years ago, and basically 2007, by the way. So 2007, since 2007, the company has basically compounded growth of about almost 18%, over 18%, whereas the S&P 500 has only done 9%. And when it comes to the average dividend growth rate, it has been 58% in comparison to that 6-7%. And when it comes to the compounded dividend growth rate for this company, 42%. Although they've only increased it basically last 7 years, they have been paying that dividend as well. So it's basically good to see the company that's beating the S&P 500 is slightly trading, but right now it's been oversold in my opinion. Now if we look at the forecast, for example, this is where things get interested. If we look at based on the estimates, which is 12% for 12% and so on, you'll be losing a lot of money right now. So you'll be losing about closer to £3,500 of its dollars of your money. Now if we use the normal multiple for this company, which is basically what it's been trading on the last whatever years, you'll be making about 85% on your money. So $18,573 per share is where you will be by the end of 2027, which is about 2 years ago, 2 years from now, 2.5 years. So yeah, it's interesting to see when you use the normal, and I genuinely think it's in between basically this estimate and this estimate. And in my opinion, I think this company deserves a higher multiple just because of those double-digit growth that we're expecting moving forward, as well as it being a high-quality company. So what did I do? Let me just show you, to be honest and transparent with you guys. So let's find the company and I'll show you exactly what I've done. So I added, because remember I used to have 10 shares, I bought 4 new shares of this company. Just to be transparent, I'm going to go in here and show you on the 22nd I bought basically was this 3 shares and then 1 share there, so about those 4 shares. So I now owned, okay, as you can see here, 14 shares or just over 5,000. I'm just down about less than 1%, and it's been fluctuating between that. So I slightly averaged down on the day, and then it's gone up again. And basically right now I would not stop buying. Maybe another, I would love to own maybe another 6 shares of this company and just leave it alone for quite some time. But that's the first one. And the second one is Mid-America apartment communities. And the reason I did this is because I really didn't want to lose my percentage in terms of REITs that I had in the portfolio. So real estate investment trust, I wanted to kind of sort of maintain that. I believe this stock is slightly overvalued in my opinion right now, and I just want to leave it for a bit. But I just couldn't help because I needed that REIT, and I don't want to buy another REIT just for the sake of it. Just to give you a little bit about the company, again, another real estate investment trust or REITs, for example, for over 4%. Safety, very nice. A- in terms of the credit rating side of things. 75% when it comes to payout ratio. Remember, we go up to 90% when it comes to the REITs because that's legal. They have to do those things. And growth for the last 5 years has been good. Lately, it's been slightly slow. 14 years of basically increasing that dividend. You get over 6%. Now, we use FFO when it comes to these companies. So the FFO is the payout ratio. Again, decent, below that 90% that we're normally looking for the REITs. Free cash flow, we don't bother with that one. And then as you can see, the FFO per share has been growing. It's, of course, REITs are a little bit cyclical, so you can see a little bit choppy here, up and down. And then when it comes to shares outstanding, they basically kept it for quite some time, which is nice to see. And revenue has been heading the right direction. Now, return on equity, return on invested capital, operating margins, free cash flow margins, yeah, they're decent, absolutely. And debt levels is slightly lower than actually some of the REITs, big REITs out there. And this is one of the reasons I own this one. Now, if we use the normal multiple just to check this out, as you can see here, basically we will be losing a little bit of money, and a normal multiple for this one we will be making about 28%. So that's one of the reasons I decided to add to it. I really like the company, and it's been in the portfolio for quite some time. I bought, I think it was 8 more shares. Let me just double check. I think I had 42. Now I've got 50 shares. So I think I bought, so there's about 4 there. Yeah, so about 9 more shares of the company. I bought this on the same day, which was good. And I'm actually would like to continue buying this, but right now I'm just going to leave it alone. Although I'm in the negative here, okay, I'm going to leave it. A lot of it is because of the FX impact. So I'm going to leave that alone for maybe another few months, see if it actually drops below. If it goes below, I think 140, then I will be really interested again. And the final one that I've added to just a little bit of Salesforce. So this is the one I'm actually using my own cash rather than, you know, that money I needed to go to these 2 companies, but I'm using my own money to actually add to this one right now in this portfolio. Don't forget, I own it in the family portfolio, so I kind of doubling up with this one. So one of the reasons I've actually want to add more of this company is that growth is now double digits when it comes to, you know, higher single digits when it comes to this. In terms of the dividend side of it is decent. It's only started very recently, so the payout ratio very, very low. That's what you will get. In terms of the things like, for example, an earnings per share, look at that beautiful graph that you know, over the last 10 years has been absolutely heading the right direction. Free cash flow per share is heading the right direction. Shares outstanding, of course, is slightly started to decline. They used to dilute it because they used to use a lot of that money to actually buy, acquire other businesses. Look at this total sales or revenue side of it, going heading to the right direction. Return on equity is getting better. Return on invested capital is also heading the right direction, as you can see that. Same goes for operating margin, free cash flow margins, and so on. And debt basically is almost non-existent. Now, if we look at, for example, let's go actually start from the beginning. As you can see, this company has been, you know, really slightly above that orange line for quite some time, and then it's gone up and then it's gone down. So now basically we only have a 2006 up until now, so it's the history side of things. And if we look at the performance, for example, against the S&P 500 for whatever, basically for the last whatever years, you could see 23%, 24% basically on your 10,000 basically dollars investment, which is absolutely amazing over the last years. So dividends, like I said, is very, very new thing. And final thing is the forecast moving forward. If we use the normal estimates, those double double digits here, you can see it seems basically is overvalued. So you'll be losing about closer to £2,000 of your money if you bought it today. But if we use a normal multiple for this one, this is where it basically shines. And that right now, if you bought the stock right now based on this, you will be making 22,000. So 120% basically total rate of return by 2028. Okay, so this company trades in normal year, so it's a basically 2028 January 31st of January you will have 120. Again, that's just an estimate based on this basic valuations that we've seen over the last whatever years. So it will be interesting one to add to. So I'm literally, I can't remember how much I've added, but I own, let me show you how many stocks I own, about 15.4 shares of this company. And I just bought a little bit, I think it was just below 1 share recently. I'm going to start buying a bit more because I haven't, since April of last year. They paid me April. When was the last time I bought this? April. Okay, so about half a share, less than half a share in April 2025. So just basically this year. So I'm going to continue buying this one. I want to basically round it up just to at least 20 shares before the end of this year. That's the long-term plan. Inshallah, I'll let you guys know how it goes. But that's what I wanted to share with you guys. If you enjoy this type of transparency, if you haven't liked the video already, like the video, subscribe to the channel. Let me know if you have any questions. As you can see, the portfolio is doing well over the last few days. I think for this week we're up quite a bit. For the 1 month, I think we're up about almost £3,500 for the last 3 months, over £10,000, which is absolutely amazing. At some point I think it was like 106,000, and right now we're looking about that much. So alhamdulillah, things are getting better for overall. Again, as we don't care what the price is showing right now. What's important is that you're buying high quality businesses, holding it for the long term. And again, if you're interested in finding out a bit more basically about my other portfolio that I have, and you want to let me know about your own portfolios, you want to learn about more about investing, you want to get hold of the 30 companies that I shared on the basically with the community recently about different types of companies, dividend paying companies and so on, then of course you join us. It's only going to cost you about over just £5 a month, and you're going to get a lot out of it, and it definitely helps the channel as well. Have a wonderful day. Assalamu Alaikum.